So you're 58 years old, you've got maybe $200,000 in your 401k, and every time you check your Social Security statement online, you're calculating whether you can actually retire at 62. You're running the numbers constantly. Can I take it early? Should I wait? And here's what's eating at you. You have no idea if the system is even going to be there when you need it. That exact anxiety, it's costing you potentially 6 figures in retirement income because of decisions you're making or avoiding right now. My name is Shura, and I spend way too much time thinking about Social Security strategy. If you're someone who's been told to just wait until 70 without understanding why, or you're terrified that Social Security is going bankrupt and you need to claim at 62 before it all disappears, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because look, 2026 isn't just another year. The Social Security Administration just announced changes that are going to affect when you should claim, how much you'll receive, and whether your current retirement plan actually makes mathematical sense. Here's the thing, the cost of living adjustment for 2026 is 2.5%. Now you might be thinking, okay, my check goes up a little bit, what's the big deal? But here's what most people don't realize. If you're currently receiving $1,800 a month, that's an extra $45 per month or $540 per year. That sounds decent until you understand this. If you had waited to claim, that 2.5% increase would be applied to a larger base amount. Let me show you the math that financial advisors don't want to explain because it's inconvenient. If you claim at 62 and get $1,800 a month, you'll get that $540 annual increase. But if you wait until your full retirement age and claim $2,400 a month instead, that same 2.5% COLA becomes $720 per year. That's an extra $180 annually every single year for the rest of your life. Over 25 years of retirement, we're talking about $4,500 more, and that's not even accounting for compounding COLAs. Now, this is where it gets really interesting. For anyone born in 1960 or later, and that's a massive chunk of baby boomers and all of Gen X, your full retirement age is now 67, not 65, not 66, 67. Here's the psychological trap everybody falls into. You think of 62 as early and 65 as normal because that's what your parents did. But the system has fundamentally changed. If you were born in 1962 and you claim at 62, you're not taking a small haircut. You're accepting a 30% permanent reduction in benefits. 30%. Let's make this concrete. Your full retirement benefit at 67 might be $2,500 a month. Claim at 62 and you're getting $1,750 instead. That's $750 less every single month. $9,000 less per year. If you live to 85, which statistically, if you're healthy at 62, you probably will. That's $207,000 in lost income. Now you might be thinking, but Shura, I'll get it for 5 extra years. Doesn't that make up for it? And look, mathematically, the break-even point is around age 78 to 80, assuming you're comparing claiming at 62 versus full retirement age. But here's what the break-even analysis completely ignores. Inflation, healthcare costs, and the fact that your expenses don't decrease linearly as you age. The earnings limit for 2026, if you're under full retirement age, is $23,400. This is huge, and almost nobody understands what this actually means. If you claim Social Security at 62, but you're still working and earning $50,000 a year, the Social Security Administration is going to withhold $1 in benefits for every $2 you earn above $23,400. So you're $26,600 over the limit, they're withholding $13,300 of your Social Security benefit. Here's the thing people panic about. They think that money is gone. It's not. The SSA recalculates your benefit at full retirement age to account for those withheld months. But, and this is critical, you're essentially giving the government an interest-free loan for 5 years. That money could have been in an index fund. It could have been paying down high-interest debt. Instead, it's locked up. The psychology here is fascinating. People claim early because they're afraid of missing out. Then they keep working because they're afraid they don't have enough saved, and they end up in this worst of both worlds scenario where they're getting reduced benefits that are being further reduced by the earnings test. This is where most retirement calculators completely fall apart. The standard Medicare Part B premium for 2026 is $185 per month. But here's what nobody tells you. If your modified adjusted gross income is above $106,000 as an individual, you're paying significantly more. At $130,000 in income, you're paying $259 per month. At $200,000, it's $408.20. And these surcharges, they're based on your income from 2 years prior. So let's say you retire in 2024. You have a big year of income because you're cashing out vacation days, getting a severance, maybe doing a partial Roth conversion. In 2026, when you're living on significantly less, you're still being charged Medicare premiums based on that 2024 income spike. This is why Social Security timing is never just about Social Security. It's about your entire tax and healthcare strategy working together. Look, here's the framework that actually makes sense for most people. First, run your actual numbers. Go to ssa.gov, create an account, look at your personalized benefit estimate. Not a calculator, your actual statement. Second, if you're married, understand that the higher earner should almost always delay. When one spouse dies, the surviving spouse gets the higher of the two benefits. If you claimed early and locked in that 30% reduction, your spouse is stuck with that reduced amount potentially for decades. Third, and this is the part that requires real honesty, calculate your break-even age based on your actual health and family history. If everyone in your family dies at 75, the math is different than if they routinely live into their 90. Fourth, if you're still working and earning above that $23,400 threshold, seriously reconsider claiming early. The earnings test is going to eat a huge chunk of your benefit anyway. Here's what I want you to take away from this. Social Security isn't just a check you get when you retire. It's an inflation-adjusted, government-guaranteed annuity that you've been paying into your entire working life. The decision of when to claim it is one of the biggest financial decisions you will ever make, and the changes in 2026 make it even more critical to get this right. The system isn't perfect. The rules are complicated, but the math is the math, and understanding it is the difference between a comfortable retirement and spending your 70 worried about money. You've learned a lot in this video, but none of it really matters if you don't know 5 big mistakes that could make your retirement harder. So if you want to find out the surprising truth, just click on the video right here on your screen. I'll see you there.